Welcome back. Let's look at the bigger picture. Yesterday, the three major indices got hit at the same time. The Dow fell 153 points, about 2.2%. The S&P lost 1.5%. The Nasdaq dropped 1.7%, all red together. And the part that stung wasn't the size of the drop. It was that the Fed had just spoken, and the market decided the Fed didn't help. Here's what actually happened, because the headline version is a trap. The Fed held rates, no cut, as everyone expected. But the commentary after the decision turned hawkish. The whisper of a rate hike, which most of us had filed away as dead, came back into the room. And when the hike whisper returns, the stocks that hurt most are the ones that were already stretched. The long-duration, story-driven AI semiconductor names. I run every cross-market shock through 3 layers. Macro, money flow, price action. Let's run this one properly. Layer 1. Macro. The higher for longer story isn't dead. A cut is off the table for now, and a hike is back in the conversation. Why does that matter for equities? Because the AI semi-trade was priced for a friendly rate path. Easier money, lower discount rates, infinite patience for future earnings. When the hike whisper returns, that math reprices overnight. It's not that the AI thesis broke. It's that the multiple you were willing to pay for it just got smaller. The Fed didn't change the technology. It changed the cost of owning it. Layer 2. Money flow. This is the layer that tells the real story. Yesterday wasn't money leaving the market. It was money moving within it. Out of the crowded AI semis and into the things that pay you to wait. Defensives, staples, dividend names. Coca-Cola closed up nearly 1%, while the Nasdaq fell almost 2%. That's a rotation, not a liquidation. And rotations are survivable. Panic liquidations are not. The tape told you which one this was. You just have to read the sector, not the index. Layer 3. Price action. The 3 indices fell. But look beneath the headline. The semiconductor ETF, SOXX, dropped more than 5%, 5 times the Nasdaq's decline. And it closed below its long-term trend line, while the staples and dividend names either held or rose. If this were a real risk-off crash, everything goes down together. It didn't. It was a sector repricing on rates, concentrated exactly where the stretch was. The chart told you before the headline did. So here's my conclusion, and it's the one I'd stake my record on. This panic is sector-specific, not market-ending. The AI semi-trade got reminded that it was priced for perfection and a friendly Fed. The defensives caught a bid because in a rate scare, certainty has a price. One group is correcting, the other is doing its job. If you remember my read from last week, I told you the Nasdaq bounce was real, but not a green light. Confirm before you commit, don't chase. Yesterday was the confirmation I was waiting for, and it came in the wrong direction. That's not me being negative. That's me being disciplined. The process said wait, and waiting was right. Here's the stance I'd take. Not bearish on the index, selective within it. Watch 2 things, the 10-year yield, because that's the real vote on the hike whisper, and semiconductor leadership, because if the semis don't stabilize, the rotation has further to run. And cash is a position. The institution that did nothing yesterday isn't behind. It's just uninvested by choice. That's my read on why the screen bled yesterday. 3 layers. One answer, the Fed didn't break the market. It reminded us which parts of it were borrowed from the future. A final word, because this is exactly where retail gets hurt. When the screen bleeds and the Fed sounds hawkish, the instinct is to sell everything or buy the dip blind. Neither is a process. The tape I walked you through says this was a rotation out of the stretched and into the steady, and rotations end when the yield stops rising and the semis stop falling. Watch those two lines. They're quieter than the news, and they're right first.